All right, covered calls for beginners. Let's get started. So, a covered call is an option strategy where an investor holds a long position in an asset like stocks and sells a call option on that same asset. The goal is to generate additional income from that option premium while still holding the underlying asset. I'm going to give you a couple examples. So, let's just say you held Coca Cola for about 3 months, okay? And but you were very bullish, or at least I want to say kind of neutral on Coca-Cola. So you bought Coca-Cola on, let's just say, January 8th, and you held it. You wanted to open a covered call, which is essentially just something that you would open to make additional income just by holding the shares. You have to obviously get 100 of these shares. Open up a covered call on Fidelity and or any sort of platform out there, Robinhood, Charles Schwab, etc. And you are going to maintain ownership of these shares unless they get called. Okay, but if they don't, okay, then you are going to maintain these shares. You're going to keep that premium that they pay you, okay? And you also, what do you call it? You can also sell it for, let's just say, a little bit more, if they get called, all right? So if they get called and someone buys these shares, buys these options, then you get the premium, and also you get an additional, let's just say, 50 cents, a dollar, $3, etc., depending on how what the exact price is. So how it works: the stock you own, shares of a stock. Okay, so 100 shares of Coca-Cola. The option: so you sell a call option to someone, agreeing to sell them your 100 shares of Coca-Cola, let's just say, at a certain price. And by the way, it could be really any stock essentially. Okay, shares at a certain price, like the strike price, and if they choose to exercise the option. So premium. In exchange for selling the call option, you receive a premium, the price of the option, which is income for you. And if they get called away, you also earn additional income. You have to make sure, though, that it is obviously above what you paid for the shares. So if you get Coca-Cola, you have to make sure, if you get Coca-Cola for, let's just say, $60, you have to make sure, let's just say, that you sell, exercise this, you do the cover call, and you sell it on the open market or whatever for $73, okay, to someone. If, and let's just say they don't get called, then you keep the shares. Now, you're taking the only, I shouldn't say the only risk, but a big risk is, having the stock kind of go down in value. And if it does, and if the shares don't get called away or whatever, then you keep the stock, and you might have to wait a little bit for it to go back up, and then you can do a covered call again, and you can kind of continue this, all the way down the line, essentially, unless these calls get called away, and then you have to repurchase the 100 shares. You have to do 100 shares, I believe. To be able to do this, obviously. So potential outcomes: stock price stays below the strike price. If the stock price doesn't rise above the strike price, the option buyer won't exercise the option. You keep your shares and the premium you received. Stock price rises. So again, this is potential outcomes. So stock price rises above the strike price. If the stock price goes above the strike price, the option buyer will likely exercise the option, buying the shares from you at the strike price. You still keep the premium, but you miss out on additional gains above the strike price because you have to sell the stock, right? So let's just say you have Coca-Cola and you sell, let's just say, these 100 shares you bought at $60, but Coca-Cola went nuts, and like it did in the past couple days as I'm recording this video. If that happens, you will lose out a tremendous amount of money. Potentially, if you would have just held the shares, you wouldn't have done a covered call. and you would have potentially, let's just say, sold sold Coca-Cola from $60 to, let's just say, $73. Okay, so obviously these are just examples, but you would have made a lot more money than just selling, let's just say, the covered call at 50 cents a share. You still make money, but you don't make nearly as much as if you would have just held the stock and potentially sold it as, let's just say, a swing trade or whatever, yourself. Really? Okay, that's what happens. Now, it could go the other way because obviously doing options is extremely risky. So if Coca-Cola goes down in value from, let's just say, the price that you bought it at $60, and it goes all the way down to, I don't know, like $58, then the covered call, if as long as it goes to the date of expiration, it will expire worthless. But here's the good news for you: you get to keep the shares. Okay, so you get to keep the shares, and then you could just like set up another covered call, as long as there's an option to do so, as long as you obviously are making money, as long as it makes sense to you. Of course, if if you want these to be called away. Now, if you don't want this to be called away, then you make sure that you have that strike price be pretty high. And as long as that strike price is pretty high, then depending on, of course, what company you're selling, because if, let's just say, you're selling Eli Lilly, then anything could happen. Anything could happen. If you're kind of neutral, like an AT&T or a Coca-Cola or something, ExxonMobil maybe, then you might be in business to continue to hold those shares and continue to sell covered calls, kind of as a wheel, I would say. That's kind of the example I would use, is just that wheel in motion every couple months selling that covered call, and you also get to keep the stock. Something that I would highly not recommend. I would not recommend this at all. I would not buy any companies at all if you are bearish on the stock. If you are bearish on whatever stock it is, if you're bearish on Coca-Cola, if you're bearish on ExxonMobil, God, don't do it. Because what happens is you get let's just say you get that covered call, you sell it, whatever. Oh my God, I made $60. Great, okay. But what happens is, if you're bearish on Coca-Cola and let's just say rightfully so, the stock goes from the price that you bought it from $60 all the way down to, let's just say, 30, and then you're stuck with it. You're stuck with the stock that you didn't want in the first place. Now, I'm not saying Coca-Cola. I'm obviously beating up on Coca-Cola a lot here, but I'm not saying Coca-Cola is going to do this. I'm just saying, I'm giving an example of whether or not this could, it could happen to really any company, really. So you want to make sure that doesn't happen. So you want to make sure that you're buying great companies. Obviously, you want to make sure you're buying companies that you're still either kind of neutral on, potentially. I use that terminology with caution. But being bullish on the stock is really where I'm at, and because you're gonna buy 100 shares of this freaking company for, let's just say, $6,000, $10,000. You want a company that you're bearish on, or bullish on, I should say. Sorry, I was a little confusing there. So again, pros and cons. Extra income are the pros. Downside protection. The premium provides a small cushion against losses, though it's limited. And then the cons, obviously, limited upside. If the stock prices rise significantly, your profits are capped at the strike price. We went through this. Risk of holding the stock, as I just said, if the stock declines in value, you still incur the loss of your underlying shares. So I hope I definitely touched on just about everything when it comes to covered calls. The only thing I didn't really cover really, no pun intended, was kind of how to buy, but I'm going to cover that probably in another video. That time, pun intended. So thank you for watching, everybody, and really I hope you enjoyed this one, and I'll see you in the next one.